morning, my name is David Blackman, editor of Pensions Insight, and I'm here in the City of London at the headquarters of JLT to interview Martyn Phillips, head of buyout for JLT Employee Benefits. This is one of a series of video interviews we're conducting with leading experts from the firm. Good morning, Martyn.
Good morning, David.
What do you see as the key trends in the de-risking market over the past 12 months?
I think if I go back to 2013, what is commonly understood is that that was a record year in terms of trades that completed. So that's by value. Actually, by volume of deals, in terms of numbers of deals, it wasn't quite a record year. There was about 160 trades completed last year. We actually advised on roughly 1 in 5 of those, and so we've got quite first-hand knowledge in terms of what was going on in the market. What we found was a number of themes. First is, after the continuation of a long period of challenging economics, sponsors stockpiling cash and capital. We started to see more of our clients deploying that to remove pensions risk. So of the 30 deals we worked on, half of those were actually solvent wind-up and buyout scenarios, where the sponsor was dipping into their war chest and using some of that money to totally remove pension liabilities from their balance sheet. So that's a growing theme we saw last year. We saw insurers working harder to find innovative solutions to help schemes complete transactions. So that includes things like flexibility about what you pay and when you pay to do a deal. That's trying to dovetail into the fact that most schemes are underfunded, and therefore trading with an insurance company often will require sponsor cash injection into the pension scheme. So it's finding the best way to dovetail into all of that. What we also saw last year were insurers, and there's only a limited number in the marketplace. We're talking about, there have been 8 active insurers in the marketplace, but now with the announcement about MetLife being acquired by Rothsay, that takes it down to 7. So you could argue that perhaps we've got a contracting marketplace. I think what we saw last year and moving into this year is actually an increasing appetite of those players to participate in the marketplace. And that's increasing both by virtue of the total number of deals and size of deal that they'll work on. So we saw last year the record-breaking £1.5 billion Thorn EMI buyout, which is the largest ever. That is just an indication, I think, in terms of the largest deal that could be written now in the marketplace. Up until last year, most people would have argued that maybe 1 billion, 1.1, 1.2 billion would be the largest trade an insurer would do. Conversations we've had indicate that potentially a deal in excess of 3-4 billion is viable and possible. So de-risking is now a potential for even the largest of pension schemes, where I think the commonly held view up until recently was they were aiming for self-sufficiency and not transferring liabilities to insurers. I think that's changing. And finally, in terms of our interest in the marketplace, we have had a number of conversations with interested parties who might want to enter the market as well to increase the number of players. So that's an interesting dynamic in terms of the increasing level of interest in getting part of the action, let's just call it, where I think it's more commonly understood now that the direction of travel over the medium and long term for pension scheme risk is going to be towards insurance company balance sheets. And if you think about last year, might have transacted just under 10 billion of buy-ins and buyouts. That's just a drop in the ocean of the entire size of the UK market. And if we think that most schemes are shut to new entrants and future accrual, the direction of travel for all those schemes is generally towards pure legacy arrangements, which the sponsor is likely to want to remove at some point in the future. And running at 10 billion a year of risk removal is not going to achieve that over the next 20, 30, 40 years. It'll have to be much larger volume per annum to be able to achieve that, and therefore there's a lot of room potentially for new entrants in the market.
Where do you see this capacity crunch coming from?
Both in the UK and overseas interest actually as well. So we have certainly got insurers who are UK life insurers who are interested in the markets. I think we've seen to a degree most of the investment banks deciding to witdraw from the area. But we're also seeing overseas interest from overseas insurers. And I guess this is more with an attempt to diversify their interests globally and benefit from diversified risk pools. So not just holding risk in their own country in terms of longevity and risk, but actually looking to other countries to expand their pool of risk, but diversify at the same time, and they get benefits from that.
And how much appetite is there in the reinsurance market?
I think there's a very, very healthy appetite in the reinsurance market. The challenge actually, or the constraint there, is actually the sort of the client-facing counterparty who actually act as the single transaction point for a pension scheme. That's where there's a constraint. Behind that, the reinsurers who want that longevity risk have a very, very healthy appetite right now, and speculation is that their appetite could consume 30, 40 billion of longevity risk. The problem and challenge is finding the route to bring that together, because it's normally syndicated on any large transaction between a number of reinsurers, and finding the primary counterparty who's willing to stand in between the pension scheme and the reinsurance marketplace, and that is part of the big challenge.
JLT's done a lot of work around enhanced annuities over the past year. What do you think the prospects are for this specialised area of the bulk annuities market?
One of the things we see for the enhanced bulk annuity marketplace is that this is a good example of refining pricing of risk. If you look at the tools that are used to price a bulk annuity in a traditional sense, you only have really 4 key things you're looking at to price that risk as an insurer. It's the age of the individual, the sex of the individual, where that person lives, and the size of their pension. That's quite a blunt tool to understand longevity risk. The enhanced annuity or medically underwritten annuity goes into a lot more detail in terms of health and well-being, and understands specifically a lot more about that individual member mortality risk. And so it's a bit like any other insurances we've worked with as individuals over the last 10, 15 years. If you think about car insurance or house insurance and go back 10, 15 years, the process of applying that was very simple, short form to fill in. But they've become more sophisticated in the pricing of risk. And the reason you get more sophisticated is to remove cross-subsidies, because if you don't get sophisticated, people are cross-subsidising other people in that world without better understanding the risk. And the second thing, actually, with that is when you don't have the full vision and picture of the risk, as an insurer, you have to put in margins for uncertainty. So if you have a better understanding at a granular level of the risk associated with mortality, you can remove margins for uncertainty in your pricing. Yeah. So there should be a net benefit to pension schemes. The key part about the enhanced marketplace is it only works for smaller collections of individuals, because it's when the law of averages breaks down is when it works. So if you had a very large scheme with 10,000 lives, if an insurer allows for the average level of impairment and amongst that population, they're going to be pretty close to the mark. If they do it for 100 or 200 pensioners, they're likely to be off the mark when it comes to reality against their average assumption for that population. So it's really working for those populations. Part of the key for that market to truly work efficiently is, and again, the analogy is like to house insurance and car insurance, you have to be able to shop around. And that's because each insurer likes different risks to a different degree. So in the enhanced annuity space, if you were an individual buying your own enhanced annuity in the retail market space, you'd find they give different levels of smoker discount. Or if you had diabetes, you'd find differing levels of improvements in your annuity because of that. So depending on the makeup of your impairments, you might find the best price comes from one insurer or another. What wasn't able to be done until fairly recently is broking those exercises on the whole of market, because each insurer had their own underwriting technique and method of extracting information from the pensioner to be able to provide an underwritten price. And what we developed last year and completed the first ever trade in this marketplace on this basis was a whole of market approach to underwritten or enhanced bulk annuities, where there was a single questionnaire that the information gathered through that questionnaire and through the process, which is run by a third party, is shared at the same time with up to 4 insurers, who will then provide a quote off that information as opposed to running their own process. And we think that evolution is key and fundamental to the development of the marketplace going forward. And we know that we've seen an increasing trend for smaller deals to be on an enhanced or underwritten basis. So last year, Partnership, I think, wrote 10 transactions out of the 160 odd in the market. Just Retirement wrote 2 transactions last year. So that's a dozen, so it's less than 10%, but that was really the first year that those two were in full flow, let's just say. And we do anticipate that this year we'll see a much larger proportion of the smaller trades being on an underwritten basis. And that will be further reinforced by MetLife's move from operating as MetLife to being part of the Rothsay Life portfolio, let's call it, where Rothsay Life's focus up till now, and I don't know if this will change, has been on larger transactions. So that might have removed MetLife from the smaller deals, and MetLife didn't write any trades on an underwritten basis. That wasn't part of the marketplace they were interested in. So we have one less party who is promoting a traditional bulk purchase annuity in the smaller space. So now the majority of players in that smaller deal space are offering an underwritten proposition.
And what kind of impact is this having on the wider market? Is it facilitating, is it smoothing the way for wider deals?
It is actually, and there's an interesting crossover between the small and large deals, and that's to do with segmenting the population of pensioners you have. So for larger pension schemes, you might argue, well, this enhanced underwritten market isn't for them. Yeah. Actually, it can be, and we've already seen a couple of trades where it's worked for larger schemes. And that's by saying, is there a subgroup of your population of pensioners where if you traded that on an enhanced underwritten basis, you might get a better overall price? And that subgroup will tend to be your largest pension liabilities. And the reason for that is, again, if you took your 10 largest pensioners in any pension scheme, you might find they account for, let's say, 50% of the liabilities of the pensioner population, or might even be just 30%. But it's a lot of concentration of risk. Yeah. Yeah. When a traditional insurer is provided with postcode, age, sex, and size of pension for that group, the size of pension piece probably dominates their pricing from a longevity risk perspective. Yeah. Because as soon as they say, well, the top 10 have an average of 100,000 a year pensions, they're going to take quite a cautious view in terms of how long those people will live. All you need, therefore, is a reasonable instance of impairments, and it could be just smoking, high body mass, blood pressure, which often you might well get with the people who were former executives and so forth who tend to have these bigger pensions. So just having that small, reasonable level of instance of impairments can end up with the scheme having a much better price to pay for that subgroup compared to a traditional annuity. And we saw a trade which was for about £22 million last year with partnership assurance, which only covered the largest 20 pensions in a larger group of pensioners. So it was over £1 million average per pensioner. But that was found to be the most economic way to trade that group in the marketplace.
You've expressed some concerns in the past about capacity in the market. Where do you see capacity coming from?
I suppose there's two aspects of capacity concerns. One is the ability of the insurance counterparties to engage in a transaction. They've got unlimited bandwidth in terms of the capacity they have for providing quotes to the marketplace. So the more interested parties, if we see improved funding levels we get, the more disappointed parties there will be in terms of pension schemes who can't get quotes in the marketplace, or might only be able to get one quote and can't get a competitive marketplace working for them. That's one component in terms of the number of trades. The other part in terms of capacity constraint is the processes that have been run by advisors and how effective and efficient they are, because they need to move quite quickly. We've seen a lot of disenchantment, let's call it, historically from the insurers with a number of consultancies around the processes that have been run, how long it takes to go from start of a process to actually transacting. And meanwhile, while you're trying to run the process of a transaction, ultimate affordability of a trade is changing because schemes aren't invested in exactly the right assets to match how insurers are pricing. And so during the course of a process, scheme funding's changing, insurer pricing is changing in a different way. There's a whole bunch of different things that are changing. So key to making sure that we can tap into more capacity in the marketplace is making processes move more swiftly. And that's incumbent really on advisors working with insurers to try and find much more efficient ways of making the deals work. Because if we can move more quickly, we can capture advantageous market conditions and not lose those. And so there's a lot of work that's been going in last year and more work going in this year to try and make deals happen more quickly. And our quickest deal last year from start to finish actually was 6 weeks. So that was taking the data to market, the scheme to market, and getting 3 insurers quoting for that. We managed to go from going to market to signing the deal in 6 weeks, which is pretty fast compared to where historically deals have transacted.
Finally, I gather you've been giving some thought to how the UK might be able to export its de-risking expertise. Can you tell me something about that?
Absolutely. I mean, we do strongly believe that the UK is one of the most advanced de-risking marketplaces for final salary defined benefit type liabilities. And there are many markets where there are no opportunities for exit or hedging of pensions risk. And we think that marrying up the expertise of advisors who have driven a lot and developed a lot of the processes in the UK with the increasing appetite of insurers to find other jurisdictions to complete trades, which are really helping the insurers actually diversify their portfolio of risk around pensions, will bear fruit. And we're doing some work right now in the Scandinavian countries in trying to develop a marketplace there, and we're hopeful that by the end of the first half of this year, we'll have completed the first ever trade in that marketplace for quite a sizable book of liabilities.
Thank you very much.
My pleasure, David. Thank you very much.